Hello everyone. Welcome back to the channel. Let's talk straight today about what the Federal Reserve just pulled off. And I mean really talk, not the Wall Street fairy tale version, but what it hits in your wallet, your job, your family's table. Because from here in Lithuania, watching this dollar machine grind the world, it looks like the same old elite game. They tweak a number, pat each other on the back, and you get the bill. So, December 10th, 2025, the Fed cuts their key rate by a quarter point, from 4 to 3.75%. Yeah, small slice, right? But then they announce, starting December 12th, they're buying up Treasury bills, about $40 billion over the next 30 days. And their dot plot, that fancy chart of what the big shots think, shows just one more cut in 2026, maybe another in 2027. Slow, careful, like they're tiptoeing around a bomb they built themselves. Sounds boring? Come on. This is the price of money for the whole damn planet. It sets your mortgage, your business loan, a cost of your groceries when the dollar flexes. You feel it here in Europe. Fuel jumps, imports sting, your savings rot while they play. Does this piss you off yet? That a room of suits in Washington decides if your heating bill spikes another 10%? Good. Let's break it down, simple and angry, so you see the scam. Look, they admit growth is crawling. For 2025, GDP around 1.6%. 2026, maybe 1.8. That's not a boom, brothers. That's a tired old truck sputtering down the highway, barely avoiding the ditch. Enough to keep the headlines from screaming recession, but not enough to put real money in your pocket. You know what that means? Your wage freezes while prices creep. Families squeeze. SMEs cut corners. And these Fed geniuses, they call it stable. Stable my ass. Ha! Stable for their bonuses, maybe. Consumer spending. Still there, they say. People swiping cards, hitting shops, grabbing a beer after work. But slowing down from mid-year. Cooling, like a fever breaking, but leaving you weak. Households under pressure. That's code for you're tapped out, folks. Feel that? Your credit card bill from last month, staring back like an old enemy. Why? Because rates stayed high too long. And now this tiny cut is supposed to fix it? Seriously, think about it. Breathe. Feel that frustration building? Good. Now the business side, where it really hurts ordinary guys like us. Enterprises whining about weak demand, especially in spots that hate high rates. Construction? Dead slow. Housing? Stalled. Prices insane, but sales flat. Durable goods, big investments, all choking on borrowing costs. When money's expensive, you don't build factories or buy trucks. You hunker down, lay off a shift, pray for tomorrow. And in Europe, we feel the echo. Your exporter buddy loses orders because US demand cools. Dollar stays strong. Pissed yet? You should be. These clowns hiked rates to fight inflation. Smashed the little guys first. Now they nibble back like it's mercy. Labor market. Oh, this one's a gut punch. Unemployment? They forecasted drifting up to 4.5% by end of 2025, 4.6% in 2026. Not apocalypse, sure, but up from the lows. And they admit job creation slowing, vacancies dropping like flies. Normalizing, they call it. Normalizing means what? Easier for bosses to pink slip you. Harder to demand that raise to cover the grocery spike. Wage power fades, just when food and rent keep climbing. Imagine your kid graduating into that. Good luck, entry-level pay. Good luck with the loans. From the Baltic edge, I see it clear. America's jobs cool, our factories idle more. Elites in DC? They project it like weather. Ha, while you're sweating the next paycheck. Does this make your blood boil? It does mine. And inflation? Here's the real joke. PCE overall at 3.0% for 2025. Core at 3.1, way above their sacred 2%. 2026, down to 2.5 maybe. 2027, 2.2. So they're whispering. Won't hit target soon, folks. Long road. Risks? Still tilted up. Energy shocks, housing rents, services creeping, even if demand stays soft. In plain words, we ain't sure this beast is tamed. Sticky, stubborn, like gum on your shoe. You feel it at the pump, the checkout. Prices that cooled but never really dropped. Why? Because their hikes crushed demand but didn't kill the fire. Now this quarter-point pat on the head, and they expect miracles? Come on. Put it together. Slow growth, jobs softening, inflation glued above target, upside risks everywhere. And they cut a measly 0.25, plan 50 basis points in 2026, another 25 later. That's higher for longer with training wheels. Not zero rates like the old days. Not a flood of cheap money. Just enough to keep the banks happy, not you. Breathe. Feel that anger? Good, because this split vote, 9 yes, 3 no, first dissent since 2019. One guy wanted half point, another said hold. Divisions, baby. Data gaps from the government shutdown didn't help. Furloughed workers meant fuzzy October numbers on jobs and prices. They're flying half blind, and you're the passenger. They chant data dependent. Watch wages, jobs, global crap. Financial stability? Worried about banks cracking, shadow loans blowing up. Risks two-sided, but leaning weak on labor. Unforeseen events? Code for war, crash, oil spike. Then all bets off. Dual mandate unchanged. Jobs max, inflation 2%. But in 2025 reality, Trump's shadow looming, pressuring Powell like a bully. Hassett yapping for half cuts if he had a vote. Elites bickering while your rent climbs. Ha, responsible? Responsible for what? Keeping the casino open? Now what hits your life next 1-3 years? Simple. No fairy tale landing. They're threading a needle. Dodge recession, tame prices, but the rope's fraying. That 40 billion T-bill tiny by QE standards, but it's plumbing fix. Banks get short safe stuff, money markets calm. Signal, liquidity squeeze over, maybe mild ease ahead. For bonds, shorts dip, longs depend. If inflation faith holds, yields ease. If sticky, they bite. Dollar stays tough versus euro, yen, weakens a tad. But strong enough to jack your imports here in Europe. Energy, oil steady high. Your bill burns. Banks and credit, real rates positive. Borrowing stings versus 2010's free lunch. Weak companies refinance in pain. Governments groan under debt service. U.S. Treasury, 2025 to 27 waves hurt. Households, variable loans dip a hair. Mortgage, car, card, but no ultra-cheap era. Fix what you can, or watch payments gnaw. Feel it? That car payment you skipped last month, now breathing down your neck. Small biz, capital costs high, demand weak. Delay hires, cut costs. Squeeze margins. Your exporter pal? Dollar strong means exports tough, imports cheap, but inflation hides in there. Why tolerate this? Elites ease for Wall Street, you grind. If growth flops below 1.6 to 1.8%, Pressure builds. Faster cuts. Markets price aggressive ease. Stocks pop. Yields drop. Breathing room for risk takers. But it screams stress. Labor cracks. SMEs fold. Unemployment races past 4.5 to 4.6. Same. Emergency mode. If inflation sticks at 3 plus, refuses 2.5 slide, stuck. Cut quick, spark fire. Slow, deepen drag. Votes turn. Volatility spikes. Bonds swing. Dollar jerks. Your pension dances. Unforeseen? Energy war. Bank blow-up. Swap lines. Big buys or hike pause if prices roar. Trump's crew? Pushing cuts for growth. But Fed splits deepen. From here, it looks rigged. They gamble. You hedge. So prepare, man. First, money ain't free no more. Plan for 3 to 4% zone, not 0. Overleverage, dangerous. One shock, you're done. Second, slow growth with bumps. Not boom, not bust. Drag with local fires. Survivors handle high rates, weak demand. Others vanish quiet. Third, clean sheets now. Households, SMEs. Fix rates smart. Pay high-interest crap. Build cash pillow. Fed says inflation road long. Risks up. No cushion. You're exposed. Fourth, eyes on jobs. 4.5 to 4.6 forecast. Wage fade coming. Don't chase tiny raises. Secure flow, skills up. Kids' future? Teach 'em tough. No easy debt era. Fifth, dollar ties. Watch liquidity. That 40 billion buy hints more if stress hits. Scale up. Risk appetite flips. Markets roar. But volatility kills sleepers. In short, Feds walking a tightrope they strung. Years of cheap booze, sharp hangover hike. Now slow detox. For us, no quick relief, no panic, just expensive grind. Flips on a dime if data bites. Breathe. Feel that? Not world's end, but no normal back. New rules, slow crawl, sticky bills, dear money. Elites jet to Davos, you count pennies. Pissed? Rethink trusting the suits. Spread this. Question the game. Question this whole circus. Why cut tiny when jobs crack and prices stick? Feel how it traps your family. Loans bite, wages flat, while banks refill? 2025 twist. Shutdown gaps mean fuzzy data. Trump's push adds chaos. Predict. Next shock, emergency flip. Your taxes bail it. Alternatives? Full ease flood. Inflation roar. Hold tight. Recession bite. Rigged either way. Elites ignore simple physics and economics to play their games. Ordinary people get the bill and the risk. If this hidden bullshit is boiling inside you, good. If not, they will keep doing it and send you the next invoice anyway. Thank you for watching. Take care of yourselves and your loved ones. And remember, slogans don't pay bills. Hard choices do.